and watch ICT Netflix. In your journal, you want to be recording that the weeks of non-farm payroll, which is typically, but not always, typically the first Friday of every month. Now, obviously, last Friday, we had a Friday in March, but it didn't post as what? Non-farm payroll. So it's this week. So tomorrow is Thursday. That's the day before non-farm payroll. We don't trade that day. And we don't trade on non-farm payroll Friday itself. Now, some of you also may be wigging out right now thinking, man, that's 2 trading days. I'm not allowed to trade in. I'm going somewhere else. I'm going to use something else. I'm just going to go and do it. Okay, that's you. But as an educator, as someone that's been doing it a lot longer than probably you have, I have to have rules. I have to have rules for the students that are under me, and it helps build discipline. And also, here's the main takeaway. The probabilities for precision fall off precipitously in Thursday and Friday of non-farm payroll Fridays. So the protocol for this week, every time there's a non-farm payroll Friday, your task as a trader is to get all of your business done by right now on Wednesday, New York session, AM session. Once we get to 11 o'clock in the morning, it's over. It's done. It's in the books. You do not trade. You do not push the button. Now, does that mean you can't demo trade? No, it doesn't mean that at all. I'm just saying that if you are one of my students that have ventured into live fund trading, which I've never advocated for any of you to do that, but I know some of you have, you want to maintain this rule by not going in and trading live funds on Thursday and Friday non-farm payroll. Yes, the market will absolutely move. Yes, the market will have setups. Yes, absolutely. But in my history of utilizing the things I'm teaching you, the level of precision isn't as precise or consistent on those 2 days of this week. So does it make sense for me as the author of all this stuff to push the envelope of risk in an environment that 3 decades have taught me that it doesn't shine as well in those days? So as a rule-based trader, as an analyst, I have to provide the trader in me a rule or a list of protocols and procedures to follow to keep the trader in line with the analyst expectation that's in me. Because inside of each one of you listening, there's 3 people. The analyst, that's the person in charge of what you're going to be doing, buying or selling. And the trader, that's the part of you that is going to be doing the engagement itself, the timing aspect of it. You're actually pushing the button, managing the risk, using the logic that's being leaned on as the analyst in you. So the analyst has to know what they're doing and have to have a rule-based idea. And it must discipline and, like a taskmaster, hold the trader in you responsible. And the trader's responsibility is to keep the gambler, which is the third person in all of you, at bay. Keep the gambler out of the driver's seat. They're going to wreck you. They're going to take risks because they want to see what happens if they push the button. Bored trading, curiosity trading, competitive, trying to keep up with the Joneses on social media trading, that type of stuff is what gamblers do. So we always try to keep the gambler out of it. It's always going to be there. Oh, this looks like something I could get a part of right now. I missed 90% of the run, but I can get that last 3 handles. I can get that last 6 pips after it's moved 90. You know what that means. You've been there before. That's the gambler. That's the part of you that just is impulsive. So you don't want to be going into these particular weeks of the month where there's non-farm payroll on Thursday and Friday of that particular week, just pushing the button to see what happens, because you know what they say, F around and find out. And this week historically has done damage to me. I've allowed it to do damage to me. I've blown accounts. That's plural, folks. Okay. I have no shame in telling you, while I was learning all this stuff, I literally smoked my accounts on these particular weeks because I was trying to force something, because I believed other people saying, these are the weeks you're supposed to trade. Look at all the volatility. This is where we got to get in here and make our moves. when the algorithms are really, really not keyed up in terms of precision. There's a lot more interest for them to be a manual intervention. That means a human comes in and intervenes and causes the market to go just outside of or well beyond what would be reasonably expected using the things I'm teaching you. So that's not a weakness to say this, okay? It's a strength, knowing where the odds are against me, whereas the classic retail trader, they just see it as, oh, this is another trading day, so therefore I got to go out there and push my edge, and then their edge is dulled because the market doesn't provide the conditions that would be conducive for high probability, low risk. And that's the reason why. So all of that, if you didn't get it all, rewind it later on and write that in your journal, because that's the reason, that's the rationale behind why I teach my students. That's why I myself maintain a sideline position on Thursday and Friday of non-farm payroll weeks. And traditionally, if I don't have anything on in the morning session, I'm done on Wednesday. Now I can, and I have traded morning sessions up to 11 o'clock. Sometimes it was a deviant and traded in the lunch hour, but we can't really do that today because we have what? At 10 o'clock, the Fed chair at 10 o'clock testifying. So in about 3 minutes or so, less than 3 minutes, we'll be seeing him bring his influence in the marketplace, if you want to call it that. I don't believe that's what's going on, but they like to use the Fed chair to do those things. Let's go over to ES. All right, so we're going to drop down into a 5-minute chart. It's a busy chart for an ICT chart, isn't it? That's up here. New week opening gap. Tonight I will have a video on the YouTube channel outlining what a new week opening gap is, what to do with it, how's it helpful, how to plot it, all that good stuff. All right, so initially what I was watching was, go to a 15-minute chart. We have a buy-side liquidity pool here, which we've swept above that. And if you look at the 60-minute chart, that's this candle's low, this candle's high, that's the SIBI, it's a fair value gap. That's what I've extended over here. Let's drop back down to a 5-minute chart. And then inside that high, we have a small little fair value gap here in the form of a SIBI. Trades up into that rate at 930. Hit that beautifully, perfect, and then came back down, swept the new week opening gap, and now we're back into touching that 60-minute fair value gap. We had relative equal highs here, so that 930 run into that fair value gap took out the buy side. So traders were caught long, took them back below the lows here, and rejection block. Most likely probably stopping them or scaring them out. This morning, I do not have a clear indication as to how I would engage it. So we're really basically just observing. If you're one of those very highly critical viewers that get to the point type thing, like yesterday was very succinct. It allowed me to cover things pretty expediently, and I don't foresee that probably happening this morning. So if you're one of those really lazy viewers, students, that's probably going to be not what we see today. And you can probably just catch this video when it's convenient for you over the weekend or something. But for the real students that are here to learn how to read price action, this is a really good exercise to watch the effects of the Fed chair talking. Now, obviously, it's 10 o'clock. Already 10 o'clock. What has he said? He probably hasn't even had the opportunity to say good morning yet. But look at the flurry of action in here. And here's our new week opening gap down here. If you look at the 930 high, okay, so all I'm going to be doing is pointing out things that are noteworthy for you to have in your journal and showing the points of reference that I'm referring to here, and that way you can study it after the day closes. But this wick here, see that? It went up into that fair value gap, cleared the buy side. Once it did that, watch what this is doing here. Where is it returning up into? Yes, it touches the bottom of the 60-minute fair value gap. Yes, that's permissible. But where are the bodies? Where are the bodies at in these two candles? in deference to this wick. Look at that beautiful return to the week opening gap. It's beautiful, isn't it? It's beautiful. So the next one of interest to me, and I'm sure you probably saw it when I was flashing my screen, which is on the daily chart. Way down here. Okay, so we have to use other tools in our repertoire. Not to say that it can't crash down here. I mean, anything can happen. I'm not saying that's happening today, but that's the next new week opening gap that I have on mine. So if we have the focus on that wick right here and draw a fill, as you can see. But ICT, I could have shorted there. Yeah, I could have. It could have ran up higher into that 60-minute fair value gap too. You have no idea. I don't have any idea what the Fed chair day testimonies is going to present in terms of volatility. But look how beautiful that retracement is off that 39.74.50 level. It's almost like it was programmed, isn't it? So this price level here is, oh gosh, can't make that out. 39.92.75. The closing price here comes in at 39.93.75. Is that a 3? Is that a 2? I can't make it out. Let me see. No, it's 93.75. 93.75. 93.75. So the close, yeah, 3993.75. So the close comes in exactly at that price. Notice it right up here. See that? That's probably random. To most viewers that are casually just watching, that's just randomness. But that's not randomness. That's algorithmic. It goes right to that. Now, the wicks can do the damage. It goes just outside the lines. And this is how the algorithm hides in plain view. In plain view, everybody that's watching price, and there's strong deniers still out there saying that there is no algorithm controlling price, when there's absolutely so much evidence to argue the point that there is. And why all of you would even wrestle that idea is beyond me. It's just, I'm sure it's unsettling. It relieved me because it made much more sense why the market does what it does repeatedly, over and over and over again. So prior to this drop off here, that candle right there is 9:55, and we started another candle at 10 o'clock. Powell didn't even get a chance to say anything. And right off of consequent encroachment, after tapping the 60-minute fair value gap that I mentioned, ran all the way down to what? New week opening gap here. Look at the beautiful delivery off of that, back up into another new week opening gap. Now, take Powell out of the conversation. Say that wasn't a factor this morning. This run up to that 60-minute fair value gap would have been a short for me. I would have smacked that. As soon as it went up and hit it, I would have done that. Why? Why would I have done that? And I can say this because you've watched me call these things live now for weeks and months on Twitter. You've watched me execute using the logic that I'm teaching you. So if you're going to wrestle with this and say, oh, this is woulda, shoulda, coulda stuff, move along. There's other people out there YouTubing, and you can be entertained by them. But I would have absolutely smacked that as a short entry had Powell not been a factor this morning. The reason why I would trust that is because we've already done the buy side here, and it also went up into the next premium range, which is that fair value gap there. So I would feel comfortable getting short there with a stop above the fair value gap once it hit that. It at one time when it was bold face green, all body, no wick at all, when it was touching that, that would be terrifying to the average trader. It doesn't make any sense to sell short into something like that, which is why it's important for you as a developing student using my concepts. You have to have the lipstick, the things that I have on my chart here. I don't have these things on my chart. It's a distraction to me to watch price with it on there because I like to keep my chart clean. But you can't do that while you're learning because you have to have the stuff on there to refer to. And it's like training wheels when you first learn how to ride a bike. It's nothing to be ashamed of. Pretty soon, in a couple months, you won't need to have the things that you're needing right now. You'll work off of a pad just like I do. This is where all my notes are written down. And I'm constantly referring to price, my other charts, and then those key levels that I have noted down, which is basically what I'm showing you here. All these levels here are just in numerical format on a pad. So I don't need to necessarily have these things on my chart, and you won't over time either. But if you choose to keep them on there, there's nothing wrong with that. Don't let me discourage you from doing it. I'm just reminding you that it's very distracting for me to have it on there. But anyway, rate of consequent encroachment of that wick here, after hitting the 60-minute fair value gap low, expansion occurs all the way down to some random 39.74.50 level. This entire run back down into that there, it only went 1/4 point lower than the 39.74.5 level. And that's a gap that's already been treated to. And as a reminder, as I mentioned yesterday, there's folks out there that just absolutely tore up that I'm teaching you something that nobody's ever touched on before. And it's not bragging. It's not arrogance. I want you to understand that these things have been in front of you and no one has ever talked about it. Never seen it before. They don't teach it. They don't know it. They've never traded with it before. It's done. Everybody sees a gap. I'm not saying I invented gaps. Gaps exist everywhere. But how I use those gaps and how I frame a narrative. You never hear anybody teach about how old gap from a week, weeks ago, is useful right now. You don't hear it. It's not taught. But there's logic behind it. There's logic behind weaving together a narrative that if there is an algorithm, okay, this is an argument for you to hold with yourself over the weekend. If there is no algorithm, pray tell, how does the market just randomly between buying and selling pressure sell off right at a consequent encroachment level in a wick that I teach you and drop immediately down into a level that I teach you that will be revisited again and then turn on a dime? If there is no algorithm, how is it that there are traders that don't have any information given to them in books and courses and educators? They don't teach this stuff. So how on earth did it just do this very thing and deliver exactly like it did? It takes more faith in the religion of retail logic that all came together for that to occur. It doesn't make any sense. So at any rate, let's take a look at NASDAQ real quick. Slightly. Pretty much the same delivery, but that's not a gap. These are my SMT studies. I'm just showing the NASDAQ and the Dow while I'm looking at ES. So let's go back to ES. I'd like to see it. So that's all it is. Just comparing. Nothing in here outside of what was just delivered there is of any importance to me now. I'd be interested to see if it can mount a deeper run into that 60-minute fair value gap. Let me show you what I'm looking at specifically when I'm referring to it. Let's scrunch this up here. All right, so we have inside the upper portion of that 60-minute fair value gap. Should we extend above? Because we've already dipped down in here. I was pretty aggressive, and we had a nice little retracement off of the level that is the new week opening gap. When I say the new week opening gap, I'm not referring to the present week. I refer to every new week opening gap as new week opening gap. If you want to have a structure to your identification, let me go back here real quick. This order block here is what I'm looking at in upper boundaries. That way I can go back to discussing the relationships between the new week opening gaps. If you want to have like a labeling system in your own charts that want to have like representing what new week opening gap, like you can label them by date using the Sunday gap opening price that would be your new week opening gap label. So if you're referring to it, you're referring to the difference between the previous week's Friday's closing price on settlement, okay, which you'll hear it talk about when we get into the video tonight. And I promise it'll be a very short video. There isn't a whole lot to it, even though it is like alchemy. It's beautiful, isn't it? It's been trending on Twitter since the first day I mentioned it weeks ago, which I think is fascinating. But the labeling system that you can utilize is obviously up to you. You can call each one of these individual new week opening gaps whatever you want to keep referencing or reference them, in a manner that is helpful to you. I don't personally require that because I know if I'm bullish or bearish, I'm looking for close proximity new week opening gaps below me. So it's really not technically difficult to understand, as you'll see tonight. It's not a lot of acrobatics that are required, but the insight that it gives you, folks. Listen. When I started last year, and I told you I was going to come out and teach and give you a mentorship level performance openly for free. I told you I was going to teach you things, and then we rolled into this year, and I told you I was going to show you what's going on behind the scenes, what makes these markets really book. Nobody else is teaching you that. They got wonderful systems. They got profitability. They have all kinds of gadgets and setups, but they're never telling you what makes the market move. They falsely attribute it to their patterns, their things, their indicators, and that has absolutely no bearing on what makes the market go up and down. I understand that I'm not everybody's cup of tea, but I have exactly what everybody's looking for. It's the truth, and it's undeniable. It's unrivaled. You can't beat the truth. You can contort it and twist it, but I'm laying it out there for you. I'm showing you exactly what you should be expecting to see in price. If there is an algorithm, these things wouldn't unfold like they do. Or if there isn't an algorithm, I should say, it wouldn't be doing these things. But because they continuously do them, there has to be a control mechanism. And the way I discovered it is I noticed that they would repeat many times within a 10-minute window. It'd always repeat over and over and over again within the same expected 10-minute window. And these certain 10-minute windows would occur in specific hours of the day, on specific days of the week, within specific months of the year, within specific seasonality. And the data doesn't lie. It's there. And then when you start looking at price action live, like we're watching here, and you anticipate these things unfold, you expect to see it. You expect to see these things. If there is some kind of control mechanism in here, it's not just buying and selling pressure, because to me, it makes no sense when I finally took a step back and said, you know what, there shouldn't be a free-for-all. Because that means a hostile entity could come in and crash our markets. If it was all just selling pressure, what would keep a rogue nation with lots of money coming in? What would prevent a large nation coming in, putting lots of money, or a group of nations coming in to pressure by selling short our equities market? Believe me, there are people and countries out there that are not friendly to us in the States. And that would absolutely be a weapon if it was just like they teach us it is. It's a free market. No, it's not. It's controlled. As it should be controlled. There should be a mechanism. And if it's a business, that means it has a process, an algorithm that it follows. And you shouldn't be afraid of it. You shouldn't be upset the fact that it's rigged. You should be thankful that it's rigged. That's what gives you the edge that you have. Because if it was absolutely 100% random, nobody could consistently beat it. Nobody could. And you should take comfort in that. My first week, when I realized that there had to be some kind of control And at first I was angry. I was like, that's why I lost everything. Well, no, I lost because I didn't know what I was doing. See the difference there? Responsibility. It's responsibility. And for many of you out there that listen to me that are always taking shots at me about how there isn't an algorithm because you know somebody's cousin's uncle who's a bank trader and they don't trade this way. I'm talking about a tier a little bit higher than him or her. They wouldn't know this because they're indoctrinated with all of their learning. The Goldman Sachs boys. They only know what they've been trained to view. This is what the market does. All we're trying to do is follow these tools, these things that have no bearing on price. No. And when you strip it away, peel back the onion every layer at a time, you start seeing things that just repeat too consistently, too frequently, too precise. Look at that fair value gap. The new week opening gap down there at 39.74.5. And look where we're at right now. Isn't that beautiful? Like, that's beautiful to see something that is completely hidden from everybody else. Outside this community, they had no expectation of seeing it going down to those levels. They had no expectation whatsoever. But you're seeing it. You've been seeing it day after day after day after day, delivering. And what's actually occurring? I mentioned it before, but because this might be your first time seeing it, so I don't know when you're coming to the channel, but a new week opening gap is a real dynamic fair value. It's a range between two specific price points that are fundamental, if you want to call it that. Where did we close the previous week on Friday? And where did we begin trading this new week on Sunday? Between those two price points, there's what? There's uncertainty. And uncertainty builds what? Opportunity. Where there's a difference of opinion, that's where the trade exists. Everyone that thinks it's going higher, opposed traders thinks it's going to go lower. That means you have a buyer and a seller. That's the reason why the new week opening gap works, because there is a real liquidity void. There's a separation between those two price points, previous Friday's close and Sunday's opening price. So what the market algorithm does, it delivers. Buyers and sellers don't take it there. You might be fortunate enough to be in a mood that rides to these levels. You did not push it there. Everyone on the trade with you in that right direction did not push it there. It's going there regardless. That's the part you don't understand. And I don't care who you are. I don't care who you worked for, who you work for now. It doesn't change the facts that this is going on every single day. And I'm predicting it. I got case studies after case studies on Twitter. And now traders are using it, making real money. Price is going to that range between Friday's closing price and Sunday's new opening price to offer fair value to the marketplace. For you and I, not necessarily. It's for large fund interest. It's to get large funds to bring their trades into the marketplace. Because what? Smart money, they're not doing one contracts. They're not trading 5 handles in a day. They're putting in size. And how do they put size on? They have to have a counterparty that is equally, if not more, interested than they are. So the market delivers it by algorithmic principles. And when that price gets delivered, because it's going there anyway, once it goes there, large funds either come in or get taken out. And that provides the counterparty liquidity for this entity that is deemed smart money, which is not bank traders at UBS, Citi, Credit Suisse. No. We're talking up above them. The folks that they're not going to be on social media. You're not going to be interviewed on CNBC. Okay, I'm sorry. But there's a whole different category that you're just not aware of. And that's who's engaging like this. That's why it's not in books. That's why no one's talked about it before, because they're not supposed to talk to you. They're not supposed to be divulging anything. And here's this joker on YouTube talking to you about it. I'm just talking about demos. I'm just talking about paper trades. That's all I'm talking about. I'm talking about the language I created. That's all we're talking about. So we're halfway between one new week opening gap and the lower one that made the low of the day so far here. And we're about the midpoint of that long wick. So that's consequent encroachment. So I'm my eyes there. I'm watching it here. I believe I'll have the video up by 10 p.m. my time. So that way, don't be sitting like on bated breath, waiting for the video to drop, prior to that. About 10 o'clock tonight, my local time, which is East Coast time in the U.S. That's when it'll be. It'll probably be about 15 minutes or less of a video. It's not going to be very long at all. Very short, succinct, right to the point. This is what you do. This is how you make them. This is how you dress your chart with it. Note the reaction halfway on that wick. See that movement? There's your consequent encroachment at 39.80 and 3/4. The low on that candle comes in at 39.80 and a half. Only went one quarter of a point, one tick below consequent encroachment, and then look at the reaction there. That is tradable. That's algorithmic delivery. Not random at all. So even in this sloppy mess, you can still see signatures and notes. That's the benefit of us being together today. That's all I'm doing. I'm pointing out things that I want your attention on when you're watching every day. Every day. What prevents us from going in and pushing a button today is the uncertainty that the market maker, that is in control of the algorithm, that can stop the algorithm from delivering on its macros and manually intervene and reprice wherever they want it to go. And you don't know when that's going to happen when the Fed chair is talking. I don't know that, which is the reason why I tread carefully. And I don't do anything. I observe. It keeps me close to the market by watching it. It's a wonderful exercise for you as a developing student. And that way, you're not becoming impulsive or chasing profits, whereas you're trying to learn the science behind how these algorithms operate. So think about the delivery from consequent encroachment down here, which I talked about at the time. It's not cherry picked, okay? I told you to watch this at the very second as it was trading there. And where it delivered from here all the way back up into this 60-minute fair value gap. Where's the buy side? Resting right above here. So we went all the way down to this new week opening gap low. We're inside the 60-minute fair value gap again. We've already did the buy side here, so that's not what we're interested in. We want to see, does it want to go above this high and trade in this order block? And completely maybe come all the way back up to the high end of that 60-minute fair value gap. Because it's already pierced this low and this low. What was below these lows here? Sell side. How far can it go down below an old low ICT? How far? How do you know how far it's going to go and it won't keep going? New week opening gaps. New day opening gaps. Opening range gaps. The gaps between where we closed yesterday and where we opened at 9:30. There's 3 specific gaps right there. I'm not going to have all of them this week, but I'll have the new week opening gap tutorial video tonight. And I don't know when I'll do the new day opening gap video, but that'll be next. And then I'll do the opening range gap video. So that way you'll have the details on gaps and how I internalize them, how the algorithm will refer to them. There's so much if you just simply put down the willingness to want to arm wrestle me and stop trying to say I'm rebranding anything. But none of this is anywhere. It's not in any books. You can get yourself $1 million if you can find it in print. Told you that. 1996, that's when it was codified. Sorry, that's me. But that range movement from the consequent encroachment of this wick, after clearing the sell side below this low and this low, I'm going to drop a line on it. Okay, so that way you can see. So below this low here, oops, sorry. Should move that one. Okay, so we have two lows here that are relatively equal. And you always want to put it right on the lower of the low between the two. So that's, I'm a little bit below it, that's okay. But from here and here. So what's resting below that? Sell side liquidity, sell stops. Traders that would want to protect a long position, they put their sell stop below that. Traders that want to sell short on a breakout, thinking that weakness that comes in, they would see that as what? A reason to be short. So if what I'm teaching you is we attack that liquidity. And the question that comes up a lot is, okay, how do you know how far if you want to be buying these stops? Because I teach how to do that in the content as I uploaded last year on my YouTube channel. And folks, please stop emailing me asking me to join my paid mentorship. I'm mentoring you right now for free. This is mentorship. Okay, I don't want your money. I'm never going to charge your money. This is it. Okay, I mean, I'm having fun doing this. You should be keeping notes and benefiting from all of it. But the question many times comes up is, you know, how can you trust? How do you know? How do you know then when it drops below old lows to be a buyer? How do you know how far it can go? Like, where would you place your stop? Well, in this case, this helps a lot when you have information like the new week opening gap, because we would expect it to drop down. This was in the chart. It wasn't off screen. It was mentioned to you that this is an interesting level. If we drop lower, this is where it's going to likely draw to. It's below these relative equal lows. So below here is sell side. So there's layered sell stops below these lows that you don't know. In the depth of market, the DOM, those orders can be spoofed. Just because you see them prompting you, saying there's this many willingness to be a seller or a buyer at a particular level, doesn't mean that that order is going to be there when price gets there. Spoofing is a real thing. Spoofing is where they put an order there, and then by the time it gets close to it, they pull the order away. So it's a gimmick. Okay, I'm sorry if you like to use that tool and it's helpful to you, that's great. But don't argue and say that that's the reason why the market's moving around, because it's not. But below these lows, there's sell side. So how far can it drop down below old lows? New week opening gap, new day opening gap, opening range gap. There's your three tools. How far can you trust a move above an old high for a turtle soup? I just taught it to you. Oops. Magic can come out of nowhere, can't it? So the market drops all the way down through relative equal lows into some random level, new week opening gap, goes one tick outside of it. Why? Remember what I was teaching you? It likes to create these little mohawks, okay? These little mohawks that overlap a little bit. Why? Because there has to be what? The bid and ask difference. So if a trader wants that 39.74 and a half, it has to trade where? 39.74 and a quarter. And that's what you got here. Everything makes sense when you understand it that way, instead of taking your price patterns and animal harmonics and Elliott wave things and try to cram all that stuff into a reason why price is going up. It has no reason. There's no basis at all for why the markets are going to be booking this way. It's going to go up for buy stops, or it's going to go up to redeliver to an inefficiency like a fair value gap. That's it. It's either going to go up for that reason for longs to sell. their long positions too, or it's going up there to start a new sell-off. So that way shorts can be implemented, and then it's going to be looking for an opposing liquidity. The market goes down for sell stops. It goes below a low or an old lows, or it goes down to an inefficiency that it will reprice to. That's it. If it's not doing that, guess what it's doing? Consolidating. Is that hard, folks? I get complaints all the time from people that don't really want to learn, or they sell something. They have a competitive nature because they're trying to sell their thing. And I'm out here teaching you what makes the market really move, and it's booking perfectly to the tick. And they'll say, I'm overcomplicating things. I'm not complicating anything. That is absolutely easy. It's totally three conditions. It's going up for one of two reasons, going down for one of two reasons, or it's consolidating. I teach you when it's going to consolidate. When we're ahead of big news or event like this, we don't know what Powell's going to say and how the market makers are going to utilize that. So what is it doing? It's consolidating. We're not trading. Why? Because it's likely to do this. And if it does move, it's uncertain. So you can't really trust it. So there you go. Now you know when the market's going to consolidate. I just taught you. I've taught you before, but I just reminded you this is what it looks like. But when you're bullish, and when I'm bullish, I'm looking for one of two things to happen. It's going to go up to buy stops above a high or relative equal highs. Or it's going up to a premium fair value gap, some kind of inefficiency where the market has dropped in the previous, I don't know, it could be as far as 60 days back. Some old high, some old price decline where there is a fair value gap. It's going to go up into that level there to reprice. That's the only two reasons why price is going to go up for me. That's it. It's simple, isn't it? It's very, very simple. That is not complicated. No matter how much you want to torture it, it's never going to submit to being complicated. That's easy. It's going up for stops or it's going up for a fair value gap. Boom, done. Over. Simple as that. Are you bullish? Okay, you're looking for one of two things. Is there a fair value gap? Nope, there ain't no fair value gap. So what's it going to go for? The stops, baby. It's going to go right up into those buy stops. Just like you're seeing it happen right there. Is it complicated when you look at it that way? Honestly, I'm asking sincerely. Because I don't believe it is. I don't believe it's complicated. It's very simplistic. And it's nothing that you should be wrestling with and trying to feel overwhelmed with. But you're trying to learn it too fast. And you can't rush it. It takes these types of things here, sitting here and watching price action. When we were down here, I said, watch that wick. Okay, that's not cherry picking. That's me taking your attention right to a very specific price level. Not a zone. Not a zone. A very specific price level. The midpoint between the closing price and the low of that candle is consequent encroachment. And I told you, as this candle was dipping down in here, I said, watch that level right here. And then I said, we want to see what? We want to see it trade back above, deeper into that 60-minute fair value gap, which is that pink shaded area. And more specifically, aim for the buy side liquidity resting above here. Why? Because we've already worked and utilized this fair value gap multiple times. So if it's going back up here, it's not going back up here for this. It's going back up for what? The buy stops resting above that. Is that complicated? Was that complicated at all in my delivery about it? It's not complicated, folks. That's not complicated. What you're feeling, if you think it's complicated, is you're feeling this insatiable desire to be able to mimic what I'm doing immediately. And that is not going to happen. It takes time. It takes time doing what we're doing here, reading price action when there's no trade involved. You're not influenced by the profit or loss. You don't care. You're indifferent to it. And that's exactly what you need to be doing while you're learning how to trade. You need to learn how to read price first. And no educator pushes this part because they want your money. They want your subscriptions. They want your everything to paying them. I don't need that. I'm giving you my time for free. I could be out here doing whatever I want to do right now, and I'm spending it with you. Who's making the greater investment here, me or you? That's what it boils down to, because a lot of you aren't really trying to learn. You want something to be easy, 1, 2, 3, watch a video one time, and you'll be able to go out there and do it right away. And I'm sorry, I don't have that for you. You can't get this level of precision with watching a video a couple times and there it is, you got it. You got to be in the charts. And that's why I unfortunately separate and divide the people. I'm very divisive, and I don't shy away from that because I want to know right away if you're a weak-minded, impatient person and you can't listen to the lectures and jawboning, you won't make it here. So leave. The ones that go through this, they're the ones that make it. Every one of these people that I'm going to be interviewing that make money with real money, they listened. They did the things I told them to do and didn't do the things I told them not to do. That's what separates them from you, what they're willing to put themselves through. These markets are extremely complicated, but I have removed that complication. I've applied a science to it. I've literally codified a logic so that way you can go in and see exactly what to anticipate, when to expect it, why it should happen. I covered every base for you, every base. There's no reason why anybody watching these live streams do not sit there and think to themselves, what the hell am I doing? Why haven't I been doing this? This makes perfect sense. This is exactly how I want to trade. I want to see the market like this. This is like knowing what's going to happen. And that's why it's called futures. We're predicting the future. Not everybody can do it, which is the reason why majority of people lose. But I have a transferable skill that you can get from me. And all you have to do is show up. Just show up. There's no PayPal. There's no credit cards. No coupon codes needed. No Black Friday sales. I love this. I live this. This is my entire life. I'm passionate about it. I'm passionate about teaching. I love transforming people into financial dynamos. And you're about to see some of them. Some of them have done extremely well. Others, very, very well, but more than not, you're going to see them in their own face, their own expressions, share what it was like for them. And I'm going to ask them questions. Some of the questions you guys gave me as a list of things that you would like to ask if it were you asking a profitable ICT student. Because I didn't want to just go in there and here's my cherry-picked questions. I'm giving you all an opportunity to go in on my Twitter and tell me what questions you would like to see me ask them. I don't want to do longer than an hour. I think an hour is really a lot, but I'm going to present each one of the students that have reached out to me. I have a lot of them that emailed me. And it's not the people that's done spreadsheets. Okay, these people have made money. They have broker statements. They have interviews with funded companies. They have cash withdrawals and receipts. So we're not talking about people that done demos. Okay, we're not talking about market replay reports on NinjaTrader. We're talking about real money. That's what I asked for. That's what you all wanted to see. And they're all going to sit down face to face with me. And it'll be a pre-recorded. So that way everything is professionally done. Nobody can interrupt us. And if I get my children or my dogs come in, I can edit all that stuff out. Live, I don't want to be distracted by that. And the questions will be emailed to all of them. So that way it allows them to have their answers prepared. Like when I was being interviewed by Corbs, I didn't know what that guy was going to ask me. And some questions, if a person is shy and maybe talking about money isn't a comfortable thing for some people. Other people are like, I can't wait to get on ICT's Jam and flex. I can't wait. That's cool. But not everybody's like that. And it'd be easy for me to cause some kind of a delay or have the expression later on, shared on another comment in the video or Twitter post where they said, oh, I wish I would have remembered this. If I ask them, say, what was your worst trading day? Because that's one of the questions I'm going to ask. What was your worst trading day and how did you deal with that? And how do you deal with losing? What's the procedure you go through? Those are questions that if you aren't prepared to talk about that and it's a wrestling match that you've gone through, it might cause you to shy away from being honest. And I want the questions in their hands first, so that way they can wrestle with it, talk about it with themselves, and say, okay, he's going to ask me this, and people are going to hear me talk about that. How do I want to respond? I don't want to be shell-shocked. I don't want to do any kind of gotcha questions, okay? Because that's like the thing that everybody wants to do. They want to, I gotcha. I got you out there. I embarrassed you. I'm not trying to embarrass anybody. I want them to be 100% honest, and I want the interview to be organic and no surprises, because I think it would be unfair for any student, any person being interviewed, to get a question upside their head, say, oh yeah, by the way, how many times has your spouse stepped outside the marriage? That type of thing. Not that this would be like that, but you know what I'm saying. Like things that would be unsavory for an interview. We're here to watch people give a testimony on how they make money, what they do, how long did it take them, what did they have to struggle through, what's their goals, what is their routine in the morning, or what session do they trade? These are all questions I plan on asking. And some of you, I've seen other questions that I didn't really think about, but are really good, and I'm going to utilize that. So I have to find a way for them to have their responses in mind, okay, so that way we don't go over an hour. I don't want to be, I'm not going to be doing a lot of the talking. The only thing I'm going to be doing is asking the question and prompting, keeping it moving along. But I want the student themselves talking. I want to hear, this is my opportunity, more so than you. I'm interested in hearing their testimony. Like I would have been willing to do this for private reasons, but I've made it public that I will be doing it and sharing it publicly. So they all know that it's going up on my YouTube channel. So if you're afraid to show your face, you're going up there, and I want you to give me permission to do that. If you don't want to do that, then obviously the interview ain't going to happen. I will not be doing it on Twitter Spaces. I don't think that's genuine. I could be hiring people, you know what I mean? Like anybody else out there could claim and say, oh yeah, he's hired somebody to do that. You don't see the person. You don't see their expressions. You don't see their emotions when they're talking about the good and the bad experience. I want you to see, which is exactly why I watch YouTubers when they live stream. I want to see their face. I want to see the expression when they talk about things that they were successful in, because their face will tell you. I want to see their expression when they talk about the painful things, because their face is going to tell you. When you're hiding your face and you're talking about things like that, it's hard to get to the root of what they had to go through. And if we're going to talk about it, let's really talk about it, right? I have a lot of respect for anybody that would be willing to do this. And I have a long list of people that have reached out to me. So I have interviews for months. And don't be upset if I haven't reached out to you yet, because there's a lot of you. I promise you, if you email me and you want to do the interview and you have proof that you're profitable with broker statements and funded account withdrawals and interviews with the company that funded you, you are absolutely 100% invited to have a conversation with me. I want to hear your story. I want to hear your testimony. And everybody else, I'm sure, would love to see that. If that's something that you want to see and you're interested in seeing, give this video a thumbs up. Let them know, because they may be sitting on the fence about it. And maybe you're shy about it. Like, well, maybe what I made wasn't enough money. Listen, if you're making money, don't think that there's a threshold. The first two guys are obviously behemoths. They've taken pretty sizable, chunks of money out of the marketplace. I'm only using them first because they are the first ones that sparked this whole interest. And I have people that have done 80,000, 50,000, 40,000, 100,000, 200,000, 300,000. You're going to see it, folks. These people have receipts, and you can't argue with that. They are doing it. And that, to me, is very inspirational as a mentor, because they did that on their own. I never one time told them to take any of those trades, and I never told them to trade with live funds. They made their own initiative, took their own initiative, and they did it themselves. It was organic, 100% organic. And that, to me, is a maverick. That, to me, is a dynamo. That, to me, is awesome. I mean, that fires me up, because they took the initiative to go out there and do something. They didn't listen to the naysayers out there and say, oh, this stuff is complicated. Oh, this stuff is fake. It's a fraud. It's this, that, other thing. You're not going to convince these folks. They're pulling down money. Spendable money, not market replay reports, not demo profits, not paper trading, okay? They're paying taxes on this money. Big difference. And I was surprised at the response I got. I mean, it's a lot. I might have to do more than one a week. I mean, it's a lot. I mean, I guess it would be reasonable to expect that, huh? With such a community the size of ours and so many people now getting into it. But at any rate, so while we didn't see a barn burner of a move this morning, and we didn't have a trending model, I gave you something real time to observe. We watched the new week opening gap deliver. And then I mentioned that we were trading down here, watch the consequent encroachment there, and then we would want to see it run up into the upper portion of that shaded area, which is what we did, and more specifically take out the buy side here. So we've done that. So the difference between that would be, we'll call it 81. So 81 to 4,002. 20 handles or so. That's not bad. What would 20 handles do for you? What if you just got 5 handles out of that 20 handles? Which is what I teach all my students to aim for as a very low rung objective when you first start out. It's easy to see 5 handles in a day, several times. But you aren't going to see these types of setups just because you watch a video. Like, you have to know a lot of things. You have to be in the charts, watching it, paint, key off of specific times of the day. Look for things that have already occurred, which was what I outlined, the sell side below here. These are relative equal lows. We went down below it here. Beautiful delivery. That's precise. You can't deny it. Rolls back up in, and then one more time tries to make an attempt to go down here, but there's no reason. Why is there no reason, ICT? How could I trust that? How did you trust to talk about it? Because you could have did it wrong in front of everybody, and they could have been laughing at you. What I've outlined here, the sell side below these relative equal lows. It goes down to a logical level, not some random place, not some random zone. I didn't refer to anything harmonic down here. These levels were already on my chart when it went down there. And then taking your attention to that level right there, this failure swing, you can now anticipate them. If you have the backdrop, the foundation behind it, that we've already went below these lows for sell side, and it went to a level that would be expected. Think about what's going on here by doing that. I'm stating that the algorithm will go back down to this level, below these lows, go there, and be content with that, and then look to do what? Reprice for an opposing liquidity or inefficiency. We had both, buy side and the remaining portion of that 60-minute fair value gap in the shaded area. I don't need it to go all the way up to the top. I just need it to go back to the buy side here. So smart money was buying below these lows. Notice it's doing that when it goes down here. This area here, which is the midpoint of this wick. Let me go back in case you guys just showed up. We were looking for this new week opening gap down here. It delivered it at 39.80 3/4. It came down to 39.50, 39.80.50. That's the low. Look up here in the upper left-hand corner. That candle's low is 39.80.50. One tick below consequent encroachment. That is below this low and this low. So the algorithm is remembering what? It's referring back to this low and this low because they're relatively equal. It does not know, listen folks, listen. It does not know your stop. It doesn't know my stop. It doesn't know how many stops. Your broker does. But the algorithm has no idea. It doesn't reference it like that. It just refers to these points, these PD arrays. So the market does what? It reprices back down below those lows, which is a discount, and consequent encroachment. They're all measurable. And there's no need to go back down to that low. Why? Because it's already repriced to the new week opening gap. And done what? The sell side has been purged. This is just returning back to a point of reference for smart money to accumulate longs. If they're going to buy here in their quote unquote smart money, and they are using what I teach as a market efficiency paradigm, that means they're going to buy stops that are below the market in the form of sell side, and they're going to distribute their long positions to buy side that's resting above the market. Willing buyers at a higher price. That's these stops right here. So they're buying sell side liquidity below these lows here and consequent encroachment. They don't fear the algorithm repricing down here because they know it's already done its job. Big, huge step forward in your understanding about price action if you can see that. So if they buy here, and I talked about this live, it's not like I'm going back in time because it's already happened. I said this live here for you so that way you can see it. The logic is real, folks. It's real. If they're buying that, what are they holding for? They're not holding for harmonic patterns. They're not looking for Elliott waves and all that other stuff. They're not counting waves. They're not doing any of that stuff. They're simply looking for the inefficiencies above the marketplace. Where is it in here? Nowhere. Here. We've already done that several times. Buying here, they're going to go exactly where I said it was going to go. The remaining portion of that 60-minute fair value gap up here that hasn't been traded to, once it went lower here, we've only delivered one time here. We went up to a quarter of it here, which is, again, not random. Then it went to halfway, consequent encroachment, and then ran through it. Like I said, that's where the buy side is. So smart money buys discount, sells to a premium. Buy stops at resting above here. They knew those buyers wanted to buy the market when it was down here. When they're down here, smart money, the paradigm shift that you're being taught to have in looking at price action, because it's algorithmic, is you're buying it here with the same mindset that they have. Smart money sees this as buying sell stops at the most opportune time. It's the precise time, folks. It's precise. You can't make it any better than this. The logic is right there. And buying that with the expectation of seeing it go where? Right to those buyers that want to buy high. Now, they don't want to buy high to buy a long position. They have they have a short, and they're holding on to their position here. Maybe there wasn't a lot of shorts. It doesn't make a difference because the algorithm doesn't know the level of float that resides above that. It means the number of orders. How many buy stops are resting above that high? I don't know. You won't ever know. The algorithm itself does not know. Buying it cheap, selling it to people that want to buy it higher. Why? Because I'm targeting their inability to know how to trade. I'm targeting their shield, their defense. I'm busting it in like the SWAT. I'm literally going through it. I'm teaching you how to do that. I'm sorry if it doesn't meet the nice feel that you think investing is supposed to be about. It's not like that, folks. This is war. And when you look at the charts, I have absolutely no moral conflict at all about taking your money or anybody else's money when you're on the wrong side of the marketplace, because you all sign the same risk disclosures when you open up your account. Everybody knows that you're likely to lose money. So if I'm buying down here, I'm doing what smart money's doing. I'm told you that that's what's going to happen there. From here, watch that. And we want to see it deliver up to this area again, but more specifically, the upper half. Why? Because it only went to here, leaving from this high up to the high shaded area here. That's not been repriced to. We only passed through one time here, then up to a quarter. So think about it like this. The range on that hourly fair value gap has been repriced to here, right there at that moment. Then this high here takes it up to that level. So the remaining portion of that fair value gap, in my mind, I'm seeing that range left. I'm ignoring all this. So you're looking at all these things trying to guess which one I should have been looking at. I'm teaching you how to internalize it, because this is the part that the algorithm sees now. It doesn't need to look at all these other highs. This is the one that matters now, because it's traded up inside that old 60-minute fair value gap, but it's left in this portion of it where it has not redelivered to it. It's only been offered sell side. So the efficiency model is that price needs to trade up into that area and deliver price that way. It does two things. It does that redelivery and goes right for the buy stops I told you it was going to aim for. Now, isn't it convenient? Isn't it convenient that the market just so happens to run right up there, clear those buy stops, and now we're right back in the middle of the range again? Hello? Hello? Are you paying attention? Are you paying attention? Are you playing with your Game Boy? Are you texting your girlfriend? I'm listening to this guy go off on YouTube. No, you need to be paying attention, taking notes. Folks, this stuff repeats every friggin' day. Every day. I talk about it in Twitter. I tell you exactly what candle to look at. I tell you exactly what it's going to be aiming for. I've been doing it for months. My private students have watched me call this on a daily chart, just the same way. And it can be done on a 1-minute chart, 5-minute chart, second chart. Yes, that's less than a minute. You cannot, absolutely cannot find anything fucking better than this. I'm sorry. This is perfect. This is the market. And if that upsets you, I'm sorry, but you're going to have to grow up. Because if you really want to know how to do this, if you really want to know how these markets book, you came to the right place. Mr. Wizard's World. We're here. We're here every day talking about the technical science and the stuff that really works. And it's undeniable. It's unrivaled. The precision cannot be found anywhere else. And that's awesome. It's encouraging when you see it, when you finally get your hands on it and you see it unfold day after day, week after week, month after month, year after year. It's infectious. It's intoxicating. You become an alcoholic. You can't imagine doing it any other way. Even in this sloppy range like this, folks, even in a sloppy range just like this, it's not chaos. It is not chaos. It's all scripted. Now, on better days, when we don't have the effects of a Fed chairman potentially saying something that could be utilized as a smokescreen and repriced completely outside of the scope of what would be reasonable, we can see trending days and keep on adding to the position until it rolls to the far extreme of the daily range, high or low. Some of you might like to think that that's the only way you're going to trade and that's your model. Wonderful. That's nothing wrong with that. That's exactly what I'm doing this for. You're going to find your model before November. You're going to know exactly how you, not everybody collectively, how you yourself, the individual watching this right now, and every time I do a live stream, you're going to learn the thing that you resonate closest to, that makes the most sense to you. You're going to see something that says, you know what? Damn it, that's exactly how I see things. And that makes perfect sense. I'm doing that. I don't care about the fair value gap. I don't care about a breaker. I don't care about new week opening gaps. This is what I'm going to do. Wonderful. And when you get there, bloom where you're planted. Don't tinker with it. No matter what else I teach, don't tinker with it, because you're here to learn how to make money. You're not here to play video games. Okay? You're not here to impress people on social media. You're not here to dance for people because they want to see you prove that you can make money. Screw them. You have bills to pay. You have bills to pay. You have ends to meet. You have places to go to and people to take care of. You don't have time to be dancing around for people that don't matter. None of these people matter that's going to demand you to do something for them. You are here to develop a skill set while you can, because this year I'm done. I'm done. The second Friday of November, we're done. ICT's done mentoring. There's no more mentoring. Okay? So you have to show up. You have to take notes. You have to put the work in. I promise you, I fucking guarantee you, you will absolutely know what the hell you're doing come November, but you have to show up every day. Stop dancing around and adding shit to this. Oh, I'm going to bring supply and demand thing to this. I'm going to bring Elliott Wave to this. Stop. Leave all that stuff at the door. If you want to pick it up when we're done in November and add it back to everything else, go right ahead. At that time, I don't give a shit. But while we're doing this, this is all that matters. This is it. This is the truth. Nothing else matters but this. You cannot argue. You cannot resist it. It's being shown to you beforehand. You guys bitched and moaned. Oh, you'll never see him go out here and live stream. You'll never see him outline all this stuff because it doesn't work. Dude, I'm doing it every fucking day. Every day. Like clockwork. You can set your watch to me. It's perfect. That's how you would expect it. If it was an algorithm, wouldn't you expect it to be like this? Some of you are thinking, what the hell just happened? This guy's usually putting me to sleep when I'm watching his videos. Oh, yeah. Well, this is what it's like when I'm live. I'm bipolar. And if that bothers you, go somewhere else. I can't not be me. But we're talking about something that I'm passionate about. I'm absolutely passionate about this. I'm passionate about your success. I want you to succeed. I want you to make money. I want you to stop working and do this on your own. Carve out your own fucking paycheck. I want you to have that. Don't you? Don't you want that? Are you here just playing around? Because if you're here just watching shit on YouTube because you're fucking bored, you're wasting your time. You're wasting your time. This is going to keep working. Until they take away the markets entirely, it's going to keep working. The market's not going to change the algorithm. I ain't changing shit. It works perfectly. Is it going to be hard in the beginning because you have all these other things that you're trying to wrestle with? Absolutely. Just like it was for me. I had all kinds of dumb stuff. Books and courses and things that I thought made things go up and down the marketplace. It's all dumb. It's stupid. And some of them have really good marketing. They make you think, wow, this is it. This is the thing I've been looking for. No, it's not. It's the thing you're being distracted with right now. And when you see, unfortunately, a little bit of success in it, and you falsely attribute it like a religion. Oh, the market went up because my harmonic camelback said it was going to go up there. Man, get out of here. Get out of here. Animal patterns have nothing to do with billions of dollars at risk. Okay, I'm sorry. It doesn't work like that. Doesn't work like that. The market's going to go where the money is. If there ain't the money in there, they're going to engineer it. That's the way it works. Above that high right here, buy stops. Somebody's short. We don't know. Retail Rick, he's short here. He's going to put a protective stop loss in there because the books say put your stop loss right above the high. He feels great when it goes down. He's going through all this chop. He's thinking, okay, maybe it's just one of those moments where I have to wait. ICT talks about this right here as a fair value gap. I got to trust it. He don't know what he's doing because he watched 3 videos and now all of a sudden he's a professional, right? The market drops down. He's thinking, all right, I'm all in now. I'm adding to it. It's great. Go watch TV. Go play golf. I'm going to be good for the rest of the day. My stop's in place. What do he make? A mistake. He traded with logic that doesn't work. He doesn't know about the new week opening gap. He doesn't understand liquidity. He doesn't understand the facts that this day is going to be consolidation because of the Fed. The market's already delivered this week, folks. It went to that dollar objective. It's non-farm payroll week. Who's in a hurry right now? Who's in a hurry? What big money entity was going to think to themselves, you know what I need to do right now? I need to take all of our customer assets and put them at risk because non-farm payroll Friday is lit. We got to get in there and make all the money on Friday. Let's get in there ahead because, it might be a big mover. I'm sorry, but that's not how this business works. Sorry. A lot of you bring comic book logic to trading when you need a PhD level education. You need to understand how the human mind thinks, how it behaves under pressure, when it's in reward. They feel like they can't lose. And that's why you see these sudden rips other direction. They don't want to give them the chance to realize they're wrong and collapse their trade and before removing what? Just like spoofing on the depth of market. They don't want them to pull those orders. So what happens? They have to run for them aggressively and quickly. Otherwise, they can't participate and utilize them as counterparty to their selling of their long position they accumulated down here where I told you. Folks, that's not complicated. That's not complicated. That is not complicated. What's complicated for you is you want to push a button and take a trade and make money right now. Because that's the only definition for you that this works, is if it makes you money right now. The few times that you've spent with me so far this year. You're going to fail if you have that mindset. You have a lot to learn. You should not be trading at all this year. If you're here to try to learn, that means you're not trading. Close your live account. Don't even leave it open, because you're going to do something impulsively. You're going to see me doing a series of weeks where I'm on fire in moves that you never would have imagined being seen and called out beforehand in detail. You're going to see that. You're going to see me pushing the button too, folks. And I don't want you being led into taking that as a live trade. Because even if you do make money, you're not learning from that. As much as you painfully need more money, like everybody else in the world, you don't learn this by putting real money at risk, because you're going to be worried about, am I going to be wrong this time? If it's moving a little bit, I'm trusting it. I've been here before, but it's retracing a little bit. Oh, no, I can't. He's probably wrong. This is going to be the time he's wrong. I should have never took this trade. You're going to close it, and it's still going to go in my favor, and you won't be in there. But you've taken a loss because you got out while it was in a retracement above the entry or below the entry in deference to a long. That's why copying people is stupid. Copying me is dumb. If you're going to try to trade, that's the stupidest thing in the world. Now, if you don't want to learn how to trade because you know yourself better than anybody else would, and you know you're not going to be disciplined, and you just want to have someone that's skilled, that provides signals to you, there's absolutely nothing wrong in that regard. There are people, even in my community, that are just like that. They just don't have the rule-based ideas that, or discipline to maintain a rule-based strategy and say, I'm not doing something right now because the rules say not to. They exist even in my community. Human beings are people that are spread across a diverse spectrum. And just because they are in my community, they hear the same videos and watch the same thing, listening to me right now. It doesn't mean that they're going to be responsible. There's lots of irresponsible students of mine. They want to blame me for the things that they did when I had no business talking about anything for them to take a live trade, especially Forex, and they're taking trades in Forex, which I'm not touching on right now. I took a trade because you told me this is what happens. That's a trade that you took. You took that. Own it. You're going to have to do that the rest of your life as a trader. You can't fault everybody else but you. When you do it wrong, own it. There's an opportunity to learn from that. Love the fact of being in these charts. If you don't like watching real-time price action, back testing old price moves and studying every small little detail about it, I'm going to tell you something. This is honest to God truth, and I'm telling you, there's no other way to describe it but this. If you don't love that part of this, you will not be profitable. You will fail. You will blow your account. You will fail your funded account challenge. You will fail to keep your funded account, even if you got it, if you don't love this aspect of it, because that's what this is, folks. You got to look at these candlesticks and love it. You got to love it. You can't stand weekends. You want to see these candles paint. And when they're not painting, you're fucking miserable. That's just the way it is. That's what makes a trader a trader. Because if you don't have that level of passion, you will not endure losses. Yes, they're going to come. Even with my stuff, you're going to lose. I lose. You're going to lose. It's normal. It's a transaction cost in this business. And unfortunately, most people that come in here are not equipped to see the adversities that come with embracing uncertainty. A lot of folks can't do it. How do you know? How do you know? I've already taught you. I told you. But that won't suffice for some of you. You want to know where it won't ever hurt you, where you won't ever take a loss. That doesn't exist. If you think that exists, get out of here. Get out of here. Just go. Don't even watch any more of my videos. Perfect trading, perfect never losing trading, getting at the highest high and at the lowest low every single time, knowing every single move, being a part of every single move. Nobody can do that for you. You have to sleep. You're going to get sick like I did last week. You're going to have a family to take care of like I do and like you do. Some of you have jobs still. Some of you run businesses. Some of you are in school. You can't be in every move. It's impossible. So how often are you looking at things unrealistically and pressuring yourself with things that don't need to be worried about? Those are not big stones. They're small little pebbles that you easily just take your shoe off, drop the pebble out of your shoe, put your shoe back on, and keep on walking forward. But many of you are just trying to do things well beyond what I'm outlining for you. Expecting yourself to know how to do it too soon. When I'm not expecting that, and I'm the instructor, it takes time. It takes time, and you have to allow your patience to form and build responsibility. And if you can't do that, it doesn't mean these concepts fail or that they've changed the algorithm or it's become the new retail. It just means that you aren't ready. That's all. It took me years to get an understanding, to know what it was I was looking for. And then even after that, I tinkered with it, which is why I told you earlier, once you find your model and you're comfortable with it, even though it doesn't deliver every single day for you, don't abandon it. Learn how to trade with that one model, because it will teach you how to allow yourself to broaden your expectations and your understanding with other models that I teach and other tools. But you have to do one thing well. You just need one thing. Buying a fair value gap, shorting a fair value gap. Shorting a breaker, buying a breaker. Aiming for buy stops or aiming for a premium fair value gap if you're long. And reverse it for being bearish and short. It's simple, folks. That stuff is simple. Just because I have a lot of tools and a lot of weapons in my repertoire and a lot of concepts doesn't mean I'm bringing everything to every chart. You're only trading what's in the chart. That's it. If it's not in the chart, you're not referring to it, right? So how hard is that? That's not complicated. But anyway, I gave you something real time. It panned out perfectly inside of a day that was already predetermined to be choppy and listless because of the Fed chairman talking. You have to know your economic calendar, folks. And then tomorrow, being Thursday, day before non-farm payroll, Friday being obviously NFP. It's a day where it's a gamble. And it can take it anywhere they want. And I don't have tools that deliver a high degree of probability that I can trust, because I think that those events are highly manipulated. That means there's manual intervention. Manual intervention, ICT can't beat that. Okay? I can't. And there's no shame in that. You want to be told where the limits are, right? You would want to know. I would want to know that. What are the strengths? Everything I talk about, how it's unrivaled. But what are the weaknesses? There are certain times of the month around certain calendar events that precision will evade you. It doesn't matter how long you've been trading. It doesn't matter how good you think you are, because I'm the author of this stuff, and I'm telling you, precision will escape you on these days over a large sample size. Once in a while, yes, I can get out there, I can call the low, trade the low, run up to near the high of the day on non-farm payroll. I can do those things, vice versa. Some of my students can do some of those things too. But does that mean it's a steady diet of every non-farm payroll we can do that? No. Sometimes the non-farm payroll event is a moot point. It just doesn't do anything. It looks like this right here. A little bit of a squirrely move at 8:30 and then doesn't do anything. And other days where it just really takes off and runs and runs and runs and runs. And who cares if it does? One day isn't your career. One trading day does not and should not encapsulate your career, but you trade like it is. Every trade. It's a make it or break it. You got the Rocky theme playing. Come on. It's a trade. If you lose, who cares? If you win, who cares? You're indifferent to the outcome. That's how professional traders conduct themselves. They don't care about the outcome. They're not over leveraging because they need a big monumental win to share on social media to get their dopamine hit, their likes up. They're in this to make money consistently and manage risk. If they take a loss or a series of losses, it's okay. It's part of it. They're not sharing it on social media so that way they can compound the pain. And equally so, you're not sharing your winners so that way you can get a sugar high. Because as soon as you do that, this is what's going to happen. Yeah, man, that was amazing. Then you're going to take the next trade. And that trade loses. And then you feel bad because you're like, oh, my sugar high's gone. Let me get it back. And you lose again. And now you were up 4% on the day. Now you're down 6. You ain't sharing that on social media now, are you? So don't provide yourself a means of being deflated by inviting social media to judge your performance. It's personal. It's absolutely personal. And if you're learning and you don't know how to trade, the worst thing you can do is share your results while you're learning, because you're not going to get the advice that you're hoping for. You're not going to get the feel good, warm and fuzzies. Somebody invariably is going to be jealous. And they're these miserable creatures. They're going to come up to your post, creep in there like a snake, and talk about how what you did was not good enough. It was stupid. That's nonsense. You got lucky. They're never going to tell you what you think they should or what you want them to do. Just like your family they're not going to understand what you're doing. They're not going to believe what you're doing can be profitable because they can't accept the fact that if you are, you're going to be doing better than them. And that's the way friends and family operate. They can tell you to your face they love you, but they love you only as long as you are just like them. And when you start crawling out of the depths of mediocrity, and they can start reflecting on how they've made mistakes and not really pursued anything in their own personal life, and you're succeeding, and they're still freaking lazy about doing anything about it, they're not going to cheer you on. Don't ask for outside cheerleaders. You need to be your own cheerleader. And that's done in your journal, your trading journal. That trading journal that you're building this year, that's going to be the best damn trading book you've ever read in your life, and you wrote it yourself. Because it's going to have real experiences that you were there. You back tested that. You watched that live session. You called that move. You saw it. And eventually later in half a year, you'll be paper trading it. So that way you'll have a real engagement with it. That's encouraging. That's the stuff that you want to build yourself up with. Things that you had your hands all over. Not, let me borrow this guy's momentum and copy his trades. And if he makes money, I make money and I can feel like I'm a good trader. That's not trading. I'm sorry, that's not trading. That's mimicking. And I have a disdain for that. I can't stand it. Because to me, it makes no sense why anybody wouldn't just go through the struggle, because it is, to learn this. Whether you learn from me or somebody else, I mean, it's hard. You have to look at yourself through a mirror that these markets will provide for you, and you're going to discover that you aren't the person you thought you were. You're going to have character flaws that are absolutely shocking to you. You're not as patient as you thought you were. You're not so disciplined as you thought you would be. And that provides opportunity for you to improve upon and build yourself up. A consistently profitable trader, let me explain something to you in closing. One of two things is going to happen. You're going to do very, very well this year in learning how to reprice. And that is going to result in one of two things. You're going to turn into the biggest prick that you could ever imagine, because you're going to have a skill set that you can literally sit down any given day of the week, go in there and make what you make a month in a trade. And you're going to know that you can do that any fucking day you want to. That is power. That's power. That brings a level of confidence that you can't even understand right now. And conversely, there's going to be the other half of you that's going to learn this, have that same aptitude, that same skill set. And you're going to think to yourself, wow, what a wonderfully blessed position I'm in right now. I am so thankful that I have this skill set right now that I can not only impact my own life, my personal family's life, maybe even a friend or a stranger. And you're going to conduct yourself in a manner that isn't ugly, that people aren't going to look at you and say, wow, you're an arrogant douchebag. Even if you are good at trading, they won't have anything bad to say about you because you're not conducting yourself in a manner that draws attention to yourself like you're some kind of fucking hero. That's the problem in this industry. Okay. We need less of that. And I'm hoping that what I'm creating with all of you, yes, you're going to be monsters. You're going to be savages in the charts, in your trading. Yes. I don't want you to be a social media douchebag. A lot of men can't wait to do it, but that would be an embarrassment to me because I did that stuff and it's embarrassing. It's shameful. And you're not going to win the majority of the community doing that. You might have some young hotshots that want to be just like you because they think that that's strength, that's influence, that's power, that's clout. When really, in all honesty, it's shit. That's all it is. It's trash. It's trashy. Nobody really has any respect for anybody like that. And if anybody does, it's fainted. It's fake. It's because they want to try to get something from you. And once they get whatever they were going to try to get from you, they're not going to worship you. And nobody should be worshiping anyone. And I'm at the top of that list. So this skill set you're learning this year, don't try to aspire to be some kind of egomaniac. It's going to be hard for some of you. Really, really hard. Because you're going to find a skill set that, number one, you didn't know existed. And you're going to be able to have the ability to make money that you've never seen before. And it's going to make you feel like you're something that you really aren't. Because you are growing into new money. And that was an experience I went through when I was a younger man. New money makes you think that you're better than you really are in all aspects. And it makes you a very toxic, ugly person. But you won't see it that way. You're going to think that I should be arrogant. I'm justified. Look at all the things I can do now. Look at the money I can make. I'm better than that guy, that guy, that guy, that guy. That shouldn't be your motivation. It wasn't my motivation initially, but when I found success, it made me think that way. Because I was a weak young man, constantly seeking validation. And as a 50-year-old man, I still seek validation because I can't get it from a family member that's passed away before seeing where I am today. So it aches in me. So if you never start it, you won't fall victim to being drugged back into it again. Because the public isn't going to give you what you think. You think they're going to worship you and lift you up on a pedestal. That's so short term, and it's not even worth it. Living your life principally oriented, purpose-driven, trying to make a positive impact in other people's lives, not trying to shit all over them because you think you're better than everybody else. If you see anything in me, understand this. I am absolutely convinced that there is not one single trader on this planet that can do this better than me. But in that same sentence, because I know that, doesn't give me the right to talk down and shit on everybody else. I'm giving you my time. I'm giving you my life's work because I want to help you. I want to see you do well. I want to see what you'll do with it. And I know, just like I've been talking about the last couple of minutes, some of you are going to abuse that power. And you're going to regret it later in life, like I did, because you acted like a fool. Because you wanted to be significant. The significance is helping other people, helping other people be better than where they are now. And that feels way better than anybody saying, "You're the GOAT. Dude, you're the GOAT, man. You're the GOAT." I ain't no fucking GOAT. Don't call me a GOAT. That pisses me off. I can't stand that. I'm not the king. I'm not the GOAT. I'm not the greatest of all times. I'm ICT or Michael. That's it. But a lot of people out there want to be called the GOAT, and they don't have the accolades to justify it. So with that, hope you got something out of this today. Hope I didn't bore too much of hole in your attention span. I'm sure some of you already logged off thinking, okay, this guy's just rambling on, but the market ain't moving, but it did what we were looking for. As small, as surgical as that was, that's all that was necessary for today. And when it does it, you stop. You move to the sidelines and be content. Even in your studies, be content with that. Close your charts, annotate them, and think to yourself, wow, we had a laboratory experiment today. We watched live price action. It behaved in a manner that was reasonable. It was expected. It made perfect sense. And now that it's done it, it's right back inside the range where everybody else is trying to figure out what it's going to do next when you don't need to worry about it. Isn't that power? Doesn't that give you a sense of calmness? There's no necessity for you to know what it's going to do next because the profile of this day indicates that it's 50-50. So if it's 50-50, is that high probability? No. You're trying to gamble. You want to have a move. It needs to be doing something because you are in front of the charts. It owes you something. No. Turn your charts off. Go do something else. Be content. Even if it moves a lot from where we are right now, who cares? Go back in tomorrow. I won't be live streaming tomorrow, and I won't be live streaming on Friday. I will be doing video work, so that's why I can catch up that with the lectures because I've been doing these live streams, pouring into you through that. But I want to do pre-recorded lectures too, so I want to get back to doing that and populate the channel for the 2023 mentorship lessons and such. So that's what I'll be doing over the next couple of days. And also doing some interviews with some of the profitable students. So I will bid you a farewell. Have yourself a very pleasant afternoon, evening, whatever you are. And until I talk to you next time, be safe.
On March 22, but as I mentioned in my testimony, the data we've seen so far this year suggests that the ultimate level of rates need to be higher. But we still have some more data to come in between now and the meeting, but as of today, it suggests a higher level than that.
Let's go to Vice Chairman Barr's review of the capital framework. A lot of questions for you on that. When Governors Brainerd, Quarles, Clarida, Bowman, and Waller made up the board under your leadership, major changes in policy were addressed following board consensus and not when there was significant dissent. Will you commit to not implementing a new capital framework following this holistic review or the Basel Endgame if there is considerable dissent from the board?
I can't really commit to that. We are a consensus kind of an organization, and that's what we'll work toward. But ultimately, we
would that be a break from your prior practices? You're a consensus builder, Mr. Chairman. You pride yourself in that, and we credit you for being a consensus-oriented chairman. Will you commit to continuing that practice and not allow major changes to the bank capital regulatory framework to be made by one person?
Well, they can't be made by any one person, but I do commit to that, and I commit to doing everything I possibly can to bring people together in consensus, to have something that can be broadly supported.
Thank you. Earlier this year, you said, and I quote, "We are not and will not be a climate policy maker." However, in the Fed's draft principles on climate-related financial risks, one proposed principle suggested that boards of directors or of a financial institution should consider making changes to its compensation policies to align with values in the context of supposed climate risks. It appears then that the Federal Reserve, through regulation, wants to begin implementing climate policies. So which is it? There seems to be a disconnect between your statements publicly and the rules that the board is putting forward for comment.
Well, I feel strongly that climate change is an important issue that needs to be addressed by elected people. It's just not something that we've been charged with by Congress, clearly. So we do have a narrow role, and that role will be around making sure that banks understand and can manage the risks that they're running, and that's going to be it. And I, as I said before, we don't want to drift into becoming a climate policymaker, and we'll have to guard that border very carefully.
Regarding the Fed's climate scenario analysis pilot program, did the board vote to approve the creation of that pilot program?
I have to check, but I don't think so. I think it was already authorized.
And this is a concern that I have. I'm concerned that one governor acting unilaterally to implement major policy changes without board consensus is a problem. And so I would urge you and your colleagues on the board to continue a consensus-oriented approach, and I yield.
Gentleman's time has expired. We'll now go to the ranking member of the House Intelligence Committee, Mr. Himes of Connecticut, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Thank you for your careful conduct of monetary policy, independent of the many political desires that circulate in this building. Independent monetary policy is a bedrock of a solid economy. I want to reflect for a moment on another bedrock of the American economy, the full faith and credit of the United States government, which is now being put at risk by the Republican majority. My Republican friends know how very dangerous a game they are playing. They know that salary payments to our soldiers are at risk. They know that their irresponsibility will raise mortgage rates for new home buyers. But they say this is the only time we focus on spending in the debt, which of course is baloney. It's a pernicious form of baloney. The time to focus on the deficit is when you are voting for the spending and the tax cuts that create the deficit. When you're voting for the Trump tax cuts, which the CBO said would add $2 trillion to the national debt, that's the moment to consider whether you want to do that. Not when the good name of the United States is hanging in the balance. This stuff gets a little complicated, but the American people really need to understand what's happening here. The Congress sits down to a huge 10-course meal of tax cuts and spending and more defense spending and expansion of this program and stimulus, all of which we vote for collectively. First course, second course, white wine, red wine, 4 servings of dessert. And then the bill comes and my Republicans say, whoa, this is irresponsible. Do we really want to pay this bill? That's not the moment for the consideration. The moment is when you're ordering 4 helpings of dessert. That's when we should be talking about it and taking responsibility for the choices that we make without putting the full faith and credit of the United States at risk. Now here's where the hypocrisy comes in. My Republican friends like to point the finger at this side of the aisle and blame us. But Chairman, as you know, fully 1/4, 25% of today's United States debt was accrued in the 4 years of the Trump administration. This country's been around for 246 years, and fully 1/4 of the United States debt was accrued under President Trump. By the way, speaking of hypocrisy, in the 4 years of President Trump, the debt ceiling was raised or suspended 3 times. I didn't even notice. But now, of course, we have a different president, and so the calculus is different. Now, Mr. Chairman, I don't think I'm going to persuade the majority to act responsibly here. I actually think the markets will persuade them. And you'll recall, because we were watching this closely, September 29th, 2008, the Republican House of Representatives voted down the Great Recession Rescue Package. As the vote was going down in the House of Representatives, the equity market dropped 7%. $1.2 trillion lost in people's retirement accounts. Now, Congress sobered up, and a couple days later, we passed the Rescue Act. So, Mr. Chairman, there is a question here, and the question is this. You and I both watch the markets pretty closely. Treasury tells us that on June 5th, that's just 3 months away, on June 5th, the Treasury runs out of money. So my question to you, Mr. Chairman, I know I'm asking you to be a little speculative here, but what should we watch for? What market signals could indicate that the markets are getting fed up with the manifest irresponsibility around this? Give us some things that we should be looking for.
And I'd love to, but I'm going to limit myself to what other Fed chairs have said about the debt ceiling, which is that it does need to be raised by Congress. In the end, there are no rabbits in
good morning,
hats,
folks.
as I mentioned.
Everybody's
And
doing
also
well.
that no one should assume that we, the Fed, this is the Fed's business, is to protect the economy from various events. And
So we're looking
I
at
wouldn't
the
assume, no one should
day
assume
2 of
that we
Powell
have the
testimony.
tools to protect the highly uncertain effects of that kind of an event.
So monetary policy is obviously very concerned with interest rates. If global capital markets begin to decide that we're really serious about hurting ourselves this time, is it possible that we could see interest rates rise more because borrowers of United States debt decide that we're actually a little risky? Is that possible?
I think that and many other things are possible. The thing is, we've never crossed that line, and if we cross that line, we're going to find out. And I think it's highly uncertain. Okay, so that's possible. And I, I don't like pressing you on these things, but you said this and many other things are possible. You want to elaborate on what might be in the category of many other things? Rather not, actually. Okay. I figured. All right. Thank you, Mr. Powell. Again, I really thank you for your really responsible conduct of monetary policy. And there's a reason that you are insulated from our political desires, and I very much appreciate that and yield back.
Gentleman yields back. We'll now recognize the chair of the Small Business Committee, Mr. Roger Williams of Texas.
Thank you, Mr. Chairman. And Chairman, it's good to see you. Always good to have you here. In past congressional testimonies, you've repeatedly stated that you support protecting the state-based system of insurance regulation, which is the most effective and competitive in the world. In my home state of Texas is the world's 7th largest insurance market, proving the success of this system. Now at the International Association for Insurance Supervisors Conference in November, there is the opportunity to have the U.S. state-based aggregation method become formally recognized as comparable or equivalent to the insurance capital standard. We should not be following the European model that has increased regulations and less competition, and we should prioritize a model that encourages deregulation, competition, and less government involvement in pricing. So my question is, Chairman, can you highlight the benefits of the U.S. state-based aggregation method compared to the European model regarding market resiliency and systematic risk? And can you confirm that you will push for aggregation method to be deemed equivalent by the IAIS?
I can say this. I do think that our insurance regulatory system has proved itself appropriate and adequate and gotten the job done for a long time, and we don't need to be copying other countries or other regions' insurance regulatory system. I'm a little rusty on the details of the capital requirements, but that sounds right.
But our bottom line is our side works, the other doesn't. We need to stay where we are.
Our side works.
Yeah, thank you. Also, in the past, you stated that banks were well capitalized. We've talked about that today, but now there have been increased conversations about raising capital requirements. Numerous economic studies have found that raising capital requirements for banks will increase borrowing costs for their consumer and commercial customers. And I'm somebody that's owned 50 years. I've never had a day I wasn't out of debt, so I'm concerned about this. And implementing additional regulatory capital requirements will slow economic growth and limit financial institutions' lending ability. So do you believe that raising capital requirements would raise the cost of borrowing and add cost to our economy in Main Street America?
Well, it depends on which banks experience higher capital requirements, and there isn't any proposal to evaluate right now, of course, but it's always a trade-off. Higher capital is good in a sense because it keeps banks able to lend during bad times. That's really a good thing. Too much capital, though, probably limits credit availability, so we're trying to strike that balance always.
And this has been touched on a little today, but let me come from a different angle on it. But the Reserve was created to act as a nonpartisan entity that remains separate from party politics. We talked about that. And unfortunately, throughout recent years, the Fed has gotten caught up in politically charged issues like economic inequality, gender and race discrimination, and climate change. Recently, the Federal Reserve Board proposed guidance on managing climate-related risks for large banks, further proving that the Fed is giving in to some political pressure and operating outside its intended purpose and responsibilities. So our country's financial leaders in my mind, should be focused on addressing runaway inflation instead of worrying about the financial institutions are doing to monitor climate change. So, and we touched on this a little bit, but how can the Fed ensure that they're not placing undue regulations and guidance on banks by forcing involvement in partisan green politics? And how's the Federal Reserve ensuring they remain separate from political influence?
I think it's absolutely critical that we do. I mean, our independence is partly founded on the idea that we will stay out of stuff that you have not assigned us to do. And if we're going to wander all over and take on the hot issue of the day, our case for our independence is dramatically weakened. On climate change, I think we do. You mentioned the guidance, and then there are also the stress scenarios, and those are the two things that we've done. We've tried to keep those tightly focused on the banks. Understanding and being able to manage the risks that they'll run over the longer time periods on climate, and not slide into a broader sort of policy making role on climate change. And I accept that could be a slippery slope and a moving border. And I just want to say, and I think my colleagues feel the same way on the board, that we're going to guard that border carefully, and we're going to stick to our role and not try to be policymakers the way in many other countries the central bank is out there in the lead with the support of the public doing climate policy. But that's not where we are in the United States, and we're not going to pretend that it is.
I've got some time left. I'll yield back, but I just want to say, as an auto dealer, I'm looking for the first day of that rate cut. Done with that. So, thank you for being here. We appreciate it.
Gentleman's time has expired. We'll now go to the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Mr. Chairman. And again, thank you for holding this hearing. Chairman Powell, pleasure to see you again. I've said it before and I'll say it again. It's always great to see you, because I always think of the old Republicans, the ones who are very noble, did the right thing, didn't play chicken with the economy, very forthright. And so anyway, I appreciate you being here very much. Like some of my colleagues on the other side, I'd say the same thing about some of them. And I appreciate you. So we heard today that the inflation is Biden's fault. So what is the inflation rate in the European Union today?
It's high.
It's high. Is it 10% possibly?
I think if you're talking about headline, I don't have this figure in my head, but it's very, very high from a headline standpoint. Yeah. And they've had core inflation move up too.
Yeah. So are they following Biden's then policies? Is that what caused the inflation? Because it seems to be Biden's fault.
So I think inflation is everywhere, and it must have to do with a common factor, and that common factor has to be the reopening of the economy and the things that were done on COVID. On the other hand, each country has a little bit different case, and I think you have to be careful. We had much more of a demand-oriented issue than they did. Now they have their inflation looks a lot like ours did a year ago.
Right. Yeah, I just had to bring it up because, again, Mr. Sherman brought it up, but it's interesting every time I hear inflation is caused by Biden, I wonder why is it all over the world? I mean, it's not because of the pandemic, of course, or, Europe's at war. I mean, that wouldn't cause it, of course. It'd have to be Biden's policies. That's ridiculous. And I think the voters saw through it last time. So I haven't been here 15 years as my good friend, Mr. Foster. I've only been here 11. But when I first got here, the boogeyman, and I heard it all from my friends on the other side, was Dodd-Frank. Dodd-Frank was going to be the end of banking. And in fact, some of my colleagues would almost scream how horrible this was. And then we got the bankers up here during a real stress test, which was the pandemic. And we asked them, has it been helpful to have Dodd-Frank? And you know what they said? Do you know what they said?
I don't.
Oh, they said it was helpful. In fact, it kept the banks capitalized. It was fascinating. Now, to be fair to them, they did complain about some of the smaller issues, but not Dodd-Frank in general, the bill. Then it seemed that CFPB, that became the next boogeyman. But they're starting to seem to fade on that, and I think the reason for that is the CFPB has actually helped so many people that now a lot of their own constituents now are getting helped by the CFPB, so all of a sudden there's not quite the energy. So now they're attacking ESG. And they're saying that you and everybody else is somehow conspiring to make sure they don't buy their oil or their coal. Are you conspiring to do that? Are you conspiring?
I don't believe we're conspiring.
No. Now, I heard it was supposed climate risk. Is there risk in the climate change?
Yes.
There is? Could it affect the bank?
Certainly, in the longer run, yes.
Yeah, of course it can. Do you think insurance companies take this into account?
Yes, actually, I believe they do.
They absolutely do.
Who write long duration liabilities, they certainly do.
Of course they do. I mean, they're very concerned with it. Weather is a big deal. I was a vice president of Liberty Mutual in their corporate legal department, and I can tell you weather and the changing of the weather, we used to have what we call catastrophes. And these catastrophes happen every 25, 50, 100 years. Now those 25, 50, and 100-year events happen every 5 years, every 2 years. So of course it is. I mean, it's ridiculous not to take a look at these ESG factors. We have to. And again, I'm glad that you guys are taking a look at it because it's real. I'm glad that, you know, the president's taking a look at it. And it's sad that my colleagues on the other side just want to stick their head in the sand and say, no, climate change is supposed climate change. No, the reality is it's real climate change, and it's costing billions and billions of dollars. And if you don't believe it, go ask all those poor people in Florida that had those huge hurricanes come through and wipe them out. So again, I appreciate very much the work that you've done. The only thing I hope is, as you said, if we ever see this pitch again, we'll know how to swing at it. And I hope we don't get the pitch of defaulting, because I'm not sure we'll know how to swing at that one. So thank you again, Mr. Chairman. Thank you for being.
Thank you.
I yield back.
Gentleman's time. Gentleman yields back. Gentleman's time has expired. We'll now go to the chair of the Oversight Subcommittee, the gentleman from Michigan, Mr. Huizenga, for 5 minutes.
Thank you, Mr. Chairman. I'm going to move quickly, and good to see you again, Chair. You know, I caught a little bit of the Senate hearings yesterday, and you had a lot of pressure to keep the sugar high going. And frankly, if the Fed and many of our colleagues had listened to what many of us were saying, we should have been weaned off that artificially low, cheap money that kept the party going. And frankly, we wouldn't be in this position. To reference Chair Greenspan's punch bowl analogy, not only did no one have the courage to remove the punch bowl, you had people cheering on the pouring of another bottle of 151 rum into the punch bowl. And here you got folks wanting to do the exact same thing. Let's spend more. It's just, and now here we are. You have an impossible decision to slow the economy or let everyone get crushed by inflation. And we know tightening means a slower economy. Slower economy means fewer jobs. Fewer jobs hit those who can least afford to lose a job. And so in short, the lower rungs of the economic ladder will suffer more than the rest of the ladder. So that's the state. That's the state of play of where we're at. I have to hit a couple of quick issues here. I wanted to start off by discussing climate, especially given the Fed's announcement in January that it was going to conduct a pilot climate scenario analysis exercise. The Fed, along with the OCC and FDIC, have each issued proposed climate risk management principles for banks that you are attempting to finalize those by the end of the year. And the requirements don't stop at the border. The UK and the EU central banks are moving to require significant ESG disclosure regimes as well. I know the Fed is taking a look at commodities capital charges in the holistic review, but even though the Fed isn't forcing banks to encompass climate analysis in their stress tests, there are many initiatives at the Fed that are going to make it more costly for banks to finance traditional fossil fuel companies. So I want to ask you a very specific question. Will you commit that you will withhold support for a new capital rule that increases capital charges on bank activities in traditional energy companies?
You know, I can't sit here and promise what I will and will not vote for, because I don't know what's going to be in the proposal. But that's not the kind of thing I think we're looking at.
I'm sorry, it's not the kind of thing.
So this isn't about this is about overall capital levels more than anything else, I think, rather than the specific thing you're talking about.
Okay. We're going to follow up on that because we need to have a real-time conversation about what that is going on there. I want to quickly switch topics and go in a different direction for this next question. I want to ask you about two opinions issued by your legal staff in November of 2019 and December of 2020 to the asset managers Vanguard and BlackRock. Mr. Chairman McHenry, I'd like to submit the two letters for the record.
Without objection.
Thank you. These opinions appear to outline the parameters of both how both Vanguard and BlackRock can operate without being deemed a bank holding company. In addition to the legal restrictions outlined by the bank holding company, these opinions listed out here in quite detail list out commitments that the companies would need to take to avoid being viewed as having, quote, control. These opinions also appear to provide assurances that the Federal Reserve Board staff would not recommend that the board find the asset managers to be bank holding companies. Further, it is unclear whether the board will take any steps beyond a periodic self-certification by the asset managers to monitor compliance with the condition that they, quote, not take any action to control a banking organization. As some asset managers play a larger role and clearly strive to influence policy in companies across the free market, we need to remain vigilant. So, Chair Powell, is the board taking any steps to assess or monitor whether Vanguard and BlackRock are complying with the commitments made in November of 2019 and December of 2020, respectively?
I would have to check and get back to you on that.
Okay.
Familiar with the issue.
I appreciate that. But that says to me that doesn't sound like there's an assessment that's taking place ongoing or scrutiny of that. Is somebody reviewing that, or is someone in charge of reviewing that?
Honestly, that's a very specific, narrow question. I'm quite familiar with the issue.
Well, it's specific and narrow to two companies, but not to an industry. I mean, that's what we need to be driving at. And I guess we need to find out whether there's somebody proactively reviewing these activities and these commitments that the companies have made as well as the Fed has made. So how often do you think they should be reassessed? Annually, monthly, biannually?
This is a very narrow set of questions. I can get you great answers really easily, but I don't have them in my head.
I look forward to those great answers, and I yield.
We'll now go to the gentleman from New Jersey, Mr. Gottheimer, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell for joining us today. Chairman Powell, when you testified before the committee last June, PCE inflation was up 6.3% year over year. Just a few weeks ago, PCE data showed that the numbers decreased to 5.4%. We're moving in the right direction, but despite the Federal Reserve raising interest rates at the highest rate since October 2007, we're still far off from the 2% inflation that the Federal Reserve is targeting. Do you believe 2% is still the right target for inflation? And given the ongoing energy transition, the push to shift supply chains out of China, and the labor shortage here in the U.S., should the Fed consider adjusting its target to avoid overly burdening Americans? Would a decline to 3% inflation be enough to offer price stability without excessive economic pain?
No, 2% inflation is going to remain our longer-term inflation goal.
Are you concerned given all the other factors that I mentioned, or do you think we just have to keep sticking with that?
I think that's got to remain our longer-term inflation goal. It's the global standard, and it's our standard, and this is not a time at which we can start talking about changing it. We have no instinct to do that.
Thank you, Mr. Chairman. The gig economy has grown significantly in recent years as more Americans are working as contractors or running small businesses. The Dallas Federal Reserve has written that gig workers are often not included in payrolls and not counted among the unemployed, and this may understate the number of Americans who could be counted as unemployed. The Fed has also noted the large number of Americans who are missing from the workforce after the pandemic. Do we need to change the way we think about measuring unemployment to account for these changes?
I missed the word you're saying.
Sorry, do you think we need to change the way we think about measuring unemployment to account for these changes?
I didn't catch this. You said, what was
gig?
The word?
Oh, sorry, gig. Gig
workers.
Yes, I'm sorry. Gig workers.
That's the word I didn't hear. Okay. No, we clearly need to incorporate gig workers both into the labor force and to whether they're working, and they certainly are working. We try to do that. It's not that we're not trying to do that. We may not be doing it perfectly.
Is there a better way to capture them? Just worried that you don't have the unemployment numbers may not, given we're still using older measurement ways. Are we updating our measurement?
We absolutely try. We're definitely trying to get those people, self-employed people. They do report in the household survey, I believe. I can get more for you on that, but I'm sure we're not doing a perfect job at it because it's a relatively new thing. But we're very well aware of it, and they're supposed to be included.
That'd be great. I'd love to talk to you more about that.
Great.
Thank you. As you're also aware, many of us are having discussions about the long-term fiscal health of our country and our economy. Like many, I worry that higher interest rates will put upward pressure on the national debt. CBO already estimates that annual interest costs will nearly triple for the U.S. over the next decade. You said to the Senate yesterday that interest payments are not a consideration of the Fed, but are you concerned that higher interest rates will more rapidly make payments on the debt unsustainable? And are there actions Congress should consider to address this issue?
So I'll say what my predecessors have said, which is that we're on an unsustainable path, and we really need to. Ultimately, we will get back on a sustainable path, and the sooner we get to work on that, the less painful it will be.
And rates, of course, were low between the financial crisis and the end of 2021, particularly low. After the target inflation rates hit, what do you think the new normal looks like in terms of rates and the Fed balance sheet over the next 5 to 10 years?
It's a really good question. There was a secular decline in longer-term interest rates, which we don't control, for 40 years to the point where they were, where the 10-year was at 10-year Treasury was at 10%, and then at the end of 40 years it was quite low. You're at higher levels. You're at, as you pointed out, levels we haven't seen since earlier in this century. I don't think anybody knows what this is going to look like 5 years down the road. So you have to ask, demographics haven't gotten better. Globalization may actually move a little bit in reverse, which would tend to produce higher inflation and thus higher rates. But you have to ask the factors that caused low rates, how much of that has changed. And some of it has, but much of it hasn't.
Building on that a little bit, what's the right metric, you think, for, if you're in our shoes, for assessing our fiscal health? Do you think we should be focused on maintaining a specific debt to GDP ratio, or is there a specific number? Are there other measures lawmakers should be focusing on?
So we've traditionally focused on debt to GDP, but many people pointed out before the pandemic that rates were secularly lower and that therefore you could look at sort of real debt service. And there was a lot of research on that. And by those measures, actually, debt service was much more easy to handle. Now we have the 10 years back close to 4%. And I think, we need to be careful not to assume that these secularly low, longer-term rates are going to continue indefinitely, because that doesn't look likely now. And frankly, most forecasts have always shown things like the 10-year going back to a higher level, so it won't be that big of a change. I think it's more or less been handled, for example, by CBO that way.
Excellent. Thank you so much, and I yield back. Thank you.
Thanks.
Now I'll go to the gentleman, the Vice Chair of the Digital Assets Subcommittee and the Chair of the Housing Subcommittee, Mr. Davidson of Ohio, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you. It's an honor to be able to talk with you today, and appreciate the work you and the monetary policy-focused portion of the Fed does. We're rooting for maybe a more consistent input from our bank regulators. So for the regulatory side, I've spoken with multiple bankers who tell me that they've never seen a higher degree of regulatory burden, steering, guidance, shaping activities in the market from regulators. Now, I don't think that's just narrowly focused on the Fed, but I'd ask you to look into it. There are a lot of people that feel like there's an Operation Choke Point 2.0 going on, and it's particularly focused on debanking people that are disfavored by, the current executive branch primarily, just like the previous Operation Choke Point was. And so to the extent that you yield any influence over the regulatory component of the Federal Reserve, I think that would be meaningful and important, because our monetary system, part of the strength of the U.S. dollar is, of course, a stable store of value. Currencies around the world are wrestling with that and inflation, and you guys are working to tackle it. But the other part is it's an efficient means of an exchange. And when people really feel like some third party is going to steer or shape their money, they don't trust it. I mean, the unbanked and the underbanked, fundamentally, that's lack of trust is part of why they don't use our banking system today. In fact, that's part of the appeal of the digital asset space, is the permissionless nature of it. It seems that a lot of people in the financial services space that have grown up in it, that are leading it today, feel threatened by the prospect of change. And if they've maybe reluctantly concluded that you can't ban crypto, they at least want to keep it account-based so that some third party can actually control the assets, which is a polite way of saying we don't actually trust our citizens to control their money or their assets. We'll let somebody else do it for them because we can control those third parties. And in fact, that's what the regulators do, isn't it?
Isn't what?
They control the third parties. I mean, if you don't comply with the regulatory regime, you don't get to operate a financial services business, right?
That's right.
Yeah. And so